Good afternoon, everyone. I hope everybody is doing well. We welcome everybody to another exciting episode on our topics when it comes to investing on the LuSE. So on today's webinar, we're going to be looking at investment risks and portfolio structuring when it comes to investing in the Lusaka Stock Exchange. We're so excited. This is our third episode. And yeah, we're here to teach you how to properly structure buying shares and managing your risks. As everything has been stated before, as good as investing on the LuSE is, it also carries some risks. So now, without further ado, I would like to note to everybody that your mics are going to be off until we have the Q&A session. That is going to be after our presenter finishes with their deliverables. And if you have any question whatsoever, you can comment in the comment section in the chat, and you can also raise your hand up. But please note, we have our relationship manager who's going to handle all your queries in the chats. And during the Q&A session, you will have the ability to raise your hand and we are going to unmute you. So without further ado, here is our top expert here at Money Acumen, our manager, our CSB manager, Spiwe Moyo. And yeah, she's the one who's going to be running us through today. So now, over to you, Spiwe.
All right. Thank you very much, Blessings, for that introduction. As mentioned, my name is Spiwe Moyo, Manager, Private Wealth, Corporate and Investment Banking here at Money Acumen. Excited to take you through this session, and I hope you pick a lot of takeaways from this session, as it serves as a very, very important item in your investment journey on the stock market. Okay, so I will share my screen as I go through the slides. Okay. All right, so as mentioned, today's topic is investment risk and portfolio structuring on the Lusaka Securities Exchange. So as we know, the LuSE has continued to grow with improved investor participation, but as it is with any financial markets, especially with small frontier markets, the key to long-term success is really understanding risk and building portfolios that deliberately grow, but not emotionally. So this session will equip you with an understanding of risk signals and really position your investment strategy for both growth and stability. Okay, so our agenda for today, those are the key agenda items. I'll take you through on how to understand risk, how to structure your portfolio, how to manage risk, and then we'll jump right into our Q&A session. Okay, so to begin, risk has been mentioned a number of times, but what is this risk? What do we mean when we actually mention risk? So in relation to the LuSE, the Lusaka Securities Exchange, or any other stock market really, risk refers to the possibility that an investor returns may differ from expected outcomes due to market, economic, sector-specific, or even company-specific factors that will influence share prices, liquidity, and eventually dividend payments. So in really simple terms, it is just the uncertainty around whether an investment will gain, lose, or fail to perform as anticipated. So we're going to categorize risk in 4 major categories for the sake of this presentation. And we'll look at market risk, company risk, sector-specific risk, as well as macro risk. Okay. Okay, so when we talk of market risk, we are referring to risk that relates to the overall behavior of the exchange. So this is not specific to a company, it's not specific to a sector, but it really encompasses the entire market. So speaking of market risk, there are 3 categories here we are looking at. Market risk, there's liquidity risk. So as we know, the LuSE is relatively a small market if we compare to our peers on the African markets or even globally. So this makes liquidity a big consideration. So what does it mean by liquidity risk? Some stocks that are listed on the LuSE do not trade daily. Those of you who are actively trading can agree with me that there are instances where we've seen stocks such as Zambia Sugar, butter be very rare on the exchange. So that means you may not always be able to buy or sell immediately. Okay, so this also affects pricing. So if a stock is rare, it affects pricing. Low liquidity can then widen the bid and ask spreads, which then reduces your ability to get the exact price that you'll be looking for as a seller on the exchange or even as a buyer. Okay, so same still under market risk when you look at price volatility. The same low liquidity can also make prices more sensitive to new information. So even just a single large trade can move prices sharply, especially for mid-cap stocks. So events such as dividend declarations, profit earnings, or board announcements often trigger a short-term price movement. A recent example would have been like the recent dividend announcement for CEC, for instance. We did see a significant price change on that stock. Still on market risk, we look at concentration risk. So on concentration risk, the LuSE has a concentration of market value in a few large companies. So we have a few large corporates listed on the LuSE. So if your investment is focused in only 1 or 2 of these counters, then your overall performance becomes highly dependent on their operation and sector performance. So that is what market risk then looks like. If we're to move to the next type of risk, here we're looking at company risk. So company risk really is what impacts individual listed companies. So previously market risk, we are looking at the exchange, the whole stock market abroad. But here now we narrow it down to specific companies, right? So what are risks that are associated with different companies? So here there's earnings risk. A company's profitability, as investors, first of all, we know that our objective for investing is to get a return. In this case, a return from investing on the stock market is through dividends and capital gains, right? So a company's profitability can change quickly due to currency volatility, interest rates, or operational disruptions. So if you remember those that were on the session last week, we looked at historic performance of some of the companies listed on the LuSE. So their profitability, their performance has got an effect on dividend payments. So as an investor, you should always examine earnings quality, year-on-year trends, and the sustainability of profit drivers, and also examining all these parameters I've mentioned. This is where us money acumen brokers then come in to handhold you to interpret financials, interpret these trends, so that even as you are making your investments, you are actually well informed. Still on company-specific risk, governance and disclosure risk. So again, those who are active on the market, you notice that there's some announcements that pop up from different brokers concerning these listed companies, be it governance related, there's new board appointments and all that. So this is a very cardinal indicator, and governance plays a significant role on Zambian listed companies. So some companies disclose information promptly and transparently, while others may lag, but it actually is a requirement that disclosure is as transparent as possible. So delayed reporting has a potential to increase uncertainty. Still on company-specific risk, dividend risk is, as I mentioned in the last session, our goal really in investing on the stock market is to get a return in form of a dividend, right? But dividend payments are not guaranteed and may vary depending on the company's performance. Remember, dividends are paid based on how the company has performed. Dividend is a portion of the profit share. So these are not guaranteed and may vary depending on the company's performance and board decisions. So even historically strong dividend paying companies may reduce payouts during weak earnings years or high reinvestment cycles. Remember, companies can choose to reinvest the entire profits into future projects. Okay, that is it on the company risks. Did I skip a slide? Okay, so dividend risk there. Now, we need to understand sector-specific risks. So we started by looking at the entire exchange as a whole, narrowed it down to company-specific. Now we are looking at sector-specific. Remember, on the exchange, the companies listed there are from different sectors. So what are some of the risks that are at play in these different sectors? So looking at if we look at the banking and financials sector, banks are sensitive to interest rate movements and non-performing loans, okay? So higher rates can boost net interest margins, but also increase credit risk. Regulatory changes, capital requirements, lending policies can also influence growth potential in the banking and financials sector. Looking at the energy sector, again, energy companies are relatively defensive due to long-term supply agreements. However, they are also exposed to tariff negotiations, infrastructure reliability, and regional demand cycles, which can then now have an impact on performance, and then it trickles down to, profits and how then the dividends will be structured. In the retail and fast-moving consumer goods, these companies really depend heavily on household consumption. Your buying power, your spending patterns is now what drives the performance of this sector. So inflation, foreign exchange movements, and interest rates influences pricing power and margins. So those are the parameters that would affect performance in retail and FMSG sector. Okay, looking at real estate, which is impacted by occupancy rates, rental yields, and commercial property demands. We have seen this, some economic slowdowns can quickly lead to lower rental occupancy, as seen during COVID-19 era, when many businesses closed, meaning they had to close shop. They didn't have like physical presence. Most of them shifted to, online business models, meaning most of the commercial properties then had lower occupancy levels. So this has an effect on the performance of the real estate sector. And diving into manufacturing and export-oriented sectors, here export manufacturers benefit from strong regional demand, but downside is they are heavily exposed to FX volatility and input cost fluctuations, which can then affect the performance of these companies. Okay, the last group of risk here that we need to understand is macro risk, and this really is what factors affect the entire stock market. These are economic and external factors that affect the entire stock market. Things like currency, inflation, and interest rates. So in terms of currency, on our exchange, the kwacha plays a very major role in company profitability. So firms with USD revenues but have kwacha expenses often perform better during depreciation cycles and the other way around. So currency swings can significantly affect valuations and dividends in the end. If we look at inflation risk, inflation affects both household spending and corporate costs for these listed companies. So a high inflation rate then compresses margins for businesses without pricing power. Okay, and interest rate. Higher interest rate increases borrowing costs. It can slow down expansion projects and reduce consumer lending. But again, this high interest rate can also benefit financial institutions through improved interest income, which can then now be translated into a dividend. So having now given a picture of what risks are associated with investing on the stock market, grouped into overall market risk, company-specific risk, and macro risk. How then do we structure risk-resilient portfolios on the stock exchange? Okay, so as you structure the portfolio, again, I will emphasize that Money Acumen Advisory and brokers, our bias is to you, our clients, and this is where we come in to handhold you throughout the journey of your investment. So our job is to ensure that the portfolio that we structure for you, with you, is in line with the objectives. So as we structure that portfolio with you, or as you are doing the structuring of the portfolio by yourself, you have to set investment objectives. Just like any other investment, whether stock market, debt market, anything, you have to have defined objectives. So every portfolio should start with a clear objective. Ask yourself why you are investing. Are you investing for income or appreciation? So this is, are you investing just for dividends or capital gains, or is it both? ask yourself, what is your time horizon? Here we're talking of 10 years. Do you have a 5-year tenure, 10-year, 15, 20, 30 years? Ask yourself those questions. How much volatility can you tolerate? Here we're asking, how much risk can you tolerate should an investment, go as not expected? How much of that loss can you tolerate? So this is your risk profile at play. So your answers to all these questions now then determine how your portfolio is structured in terms of sector allocation, stock selection, and also this trading strategy. Okay, so some principles of portfolio construction need to be at play here. And really, we're going to look at 3 key principles, which is diversification, having a defensive against versus growth allocation, income versus growth strategy. But the primary two for risk management on investing on the securities market is diversification. Okay, so you are diversifying across sectors, across risk types, across company sizes. As I mentioned in the beginning, there's risk that is associated with sectors specifically. So if you diversify, you are then spreading your risk according investment risk. You're spreading the risk across different sectors. Okay, so in terms of diversification, we need to avoid overexposure to one sector. There was a question last week with regards to investing in the agricultural sector with all the risks that is associated. And my answer was, you cannot avoid the agricultural sector because of all these risks associated with the sector. But what you can do is avoid overexposing your investment in that particular sector. Okay, so a balanced approach then protects you, the investor, during downturns. Okay. When we look at defensive versus growth allocation, which is another principle of portfolio construction, you're looking at striking a balance between defensive counters and growth allocations here. So defensive positions, really, these are positions that include utility companies, energy companies, real estate. These sectors maintain stable cash flows regardless of economic cycles to some extent. Okay, whereas growth stocks provide an upside, but also come with a higher risk. So a balanced portfolio should have a mix of the two, and this also will be dependent on the investor's risk appetite. All right. Another principle, last principle for this session, is income versus growth strategy. So this is another principle you apply as you are structuring your portfolio. So income-focused investors will obviously be more biased to banks, REITs, and utilities, whereas growth investors will be more biased to manufacturing, telecoms, and the consumer stocks. But growth investors, income investors, focus on companies with a history of consistent dividends. Here we've mentioned banks. We know that, for instance, Zanaco has been consistent with dividends year on year. Growth investors target companies which are reinvesting for expansion or benefiting from industry tailwinds. So yeah, growth consumer stocks, for instance, we've seen Shoprite constantly reinvesting profits into projects. So now that you have these principles on how your portfolio should be structured, we will get into some of the sample portfolios structured. I should make mention here that when it comes to investments on the stock market and any type of investment, there is no one size fits all. And that's the reason why we emphasize here at Money Acumen that you come and sit down with us for us to do an assessment of your risk profile, understand your objectives, and then together we curate that tailor-made investment strategy for you. But some of the sample portfolios here, one, a conservative portfolio. So this type of portfolio really prioritizes dividend stability and defensive sectors, and it's suitable for low risk investors. So typically this type of portfolio will have 50% of dividend stocks. These would be your CEC, Zanaco, REIT, and 30% into blue chip growth companies. You have your Airtels and Burberry's as examples. Then a smaller allocation, which is 20% cash. So here, cash is you are keeping cash to look out for new investment opportunities on the market. Should a new opportunity arise, at least you are liquid enough to jump on that opportunity and grow your stock portfolio. So that's a conservative portfolio. Next one is a balanced portfolio. So with a balanced one, this is a mix of reliable dividend payers and selective growth plays. So this is actually good for investors who are seeking a balance both on income and moderate growth. Typically, the combination of a balanced portfolio will have 40% dividend stocks, because there you know that you receive dividends consistently. 40% will be your growth stocks, and 20% strategic sector plays. So this will be your agri sector, telecoms, and the manufacturing sector. So this is like proper balanced portfolio, which can enable you to take advantage of both income and income in terms of dividend and growth in terms of capital gains in the medium to long term. Okay, and then the aggressive portfolio. So this one is really higher exposure to cyclical and growth encounters. So this is suitable for investors with long horizons and a higher tolerance for volatility. So those ones that are investing for long term, not medium, not short, but long term, and have a higher risk tolerance. So the composition of this will be 20% dividend stocks, because here the focus really is not so much income, but it's more heavy on growth. So it will have a bigger chunk allocated to growth stocks, and 20% high beta plays. Okay, so now with these sample portfolios, remember the topic we are looking at here is understanding risk, and we need to know how to manage risk. Okay, so how we cannot avoid risk, but we can actually avoid risk. Again, I'll emphasize here, as Money Acumen Advisory and Brokers, it's our duty, our role to make sure that we guide you on how to manage risk on your investment portfolio. So a few pointers, a few key pointers on how you can manage risk. I mentioned we cannot avoid it, but we can manage. So one of them is use stop loss or target exit prices. Okay, so here you just set your target entry and exit levels, and stay disciplined. So here you're just trying to manage downside. We monitor at what price you bought at. We monitor the prices, and we use a stop loss for you to exit if the stock price is heading towards a price that will be significantly lower than the price that you bought at. Another strategy to apply here is monitor annual reports and trading statements. Again, this is something that we do at Money Acumen, one of the value-added service for you Okay, sorry about that. We had an interruption in internet. I'll just bring back my presentation. Okay. All right, so we're on managing risk, and my last point before I was kicked out was monitoring of annual reports. And I mentioned as a value addition to our services, we do provide summaries on what is happening on the exchange, overall performance on the exchange, company specific, and any other announcements that are happening on the stock market. So this helps you as the investor to stay informed on what is happening in all these companies, and if any macroeconomic updates come up, you are actually well informed. Another principle on how to manage risk is to rebalance quarterly. So again, we do have quarterly investment review sessions with our clients, and the objective really here is to look at these were our objectives when we started this investment journey. Are we on track? Are we actually achieving what the objectives are? So as a LuSE is a small market relatively, so sector ways shift quickly. So we need to rebalance. Okay, if this sector is not performing as expected, can we rebalance, sell off some positions and acquire more positions in the other stocks? Okay. Number 4 principle is hold cash for opportunities. In one of the portfolio structures, there was a 20% allocation to cash. So here the objective is to leverage cash to exploit undervalued stocks on the exchange. So if you're liquid, you have a reserve of some cash, then those stocks as they come up that we have undervalued, you can take advantage of those. Last but not least, focus on sectors with predictable cash flows. Last week's session gave an idea of cash flows for some of the different companies listed on the LuSE. So this now you focus as you manage risk, focus on predictable cash flows. Energy, banks, and real estate remain steady pillars, and they are predictable. So yeah, always maintain some liquidity so that you take advantage of cash positions. All right. So key takeaways from today's session is that the LuSE has continued to offer strong opportunities for both income and capital growth. But essential to all that is risk awareness. As I mentioned, you cannot avoid it, but we can manage risk. Okay, so your portfolios, even as you are structuring them, as we structure those portfolios for you, with you, the portfolios must be diverse, balanced, and align with investor objectives. All right, and the goal here is really not to eliminate risk, but to manage it intelligently. Okay. So I will end here, and we'll get into the Q&A session. The moderator mentioned that some of the questions will be responded to in real time on the chat, but we will take a few questions for now. Thank you.
Thank you so much, Spirit. That was a very, very insightful presentation. Well put. And as Spirit stated, we'll now take Q&As. So if anything, you can still write in the chat, and our relationship manager is going to attend to you. And if anything, you can still raise your hand, like Mr. Dixon here. So we can start now.
Can I go through? Can I go through?
Okay, we're going to start with you, Mr. Dixon.
Okay, my question is on the micro risks, looking at the inflation risk. I
Oh,
had some people.
Mr. Dixon, do you mind
Yes.
speaking up?
Okay. I was saying my question is on the micro risks. Looking at the inflation risk. I have heard some people who say you shouldn't focus so much on the inflation, but you should focus on being consistent with your investment. Is that a good advice or not? And my other question is, how does the Bank of Zambia policies affect your risks? Thank you.
Oh, okay, Mr. Dixon.
Hello? Hello? Do you
Okay,
get me?
sir, you're not fully audible, so if you mind, you can just text in the chat box. Yeah, you're not being very audible, but we'll move on to Linda.
Oh,
You
all right, thank
can
you.
you can ask your question.
Good afternoon, Spiwe. My question is on the stocks. You gave examples, I think, of just sectors, but I wanted to know the companies that are both growth as well as income, those that have capital gain as well as pay dividends. Thank you.
Thanks, Linda. So on the principles of portfolio construction, I did give examples of which ones are growth and which ones are income counters. But just to go through that again, examples of growth positions would be your Zambif, Chilanga, your retail counters, and stable income holdings. These are your consistent dividend payments with the banks like Zanaco. So as you are constructing your portfolio, we are looking at having a mix of these sectors. So on the growth side, you are looking at Zambif, Chilanga, and Shoprite, for instance. On the income side, you're looking at your Zanaco, your CEC. These have been stable in dividend payment. I hope that answers your question.
Yes, it does. Thank you.
All right. Now we're going to go to Webster. You can ask your question.
Thank you for this very wonderful presentation. My question goes to portfolio allocation. I'm looking at our market, LuSE, which is not very liquid. How can you overcome that constraint where you want to build a portfolio and you find that the cheapest stock you're looking for is just not there? Yeah.
Okay,
Yes.
you can go on, Mr. Webster.
Yeah, so I would say that you may want to build a portfolio in the some stocks growth expensive. If you look at the reality of our stock market, it's not deep enough, it's not deep enough. So how do you overcome the constraints where you may find that your particular stocks that you want to invest in are just not there?
Okay, Mr. Webster. I don't know what's wrong with the mic. We couldn't hear your question properly. I'm just requesting you just to write it in the chat, and Spirit will attend to it. It's really breaking.
I'll do that.
All right. Thank you so much, Mr. Webster. Sandra, you're up next. You have your hand raised.
Hi, good afternoon. Am I audible?
Yes, you're clear.
Okay, thank you for the presentation. So I have two questions. I think I posted one in the chat. The first one is, are there companies that are mandated by law to give dividends? I think I heard one company CEO who said they're mandated by law. So that's the first time I heard something like that. I don't know if you can spread any light on that. And then secondly, I wanted to know if can your age or your gender affect what kind of risk appetite you have? Like maybe someone who's in their 20s and someone in their 50s, is that something that would impact your risk appetite? Thanks.
And Sandra, he sounds to me as a very high risk taker. So to answer your question on dividend mandates, so each company that's listed on the exchange has got what we call a dividend policy. So the policy then guides on the frequency of the dividend payments, what factors are at play when declaring dividends. So the policies differ from company to company. And please drop your email address in the chat. We'll actually share a more detailed summary of the dividend policies for all these companies. But to answer your question, yes, each and every company has got guidelines on when to pay out a dividend, how much of the profit should be declared to investors as a dividend. And to answer your question on risk profiling, age, yes, does play a very, very critical factor in someone's risk profile. When we are younger, our risk profiles are, we are more risk takers. But as we age, most people aged people have a lower risk tolerance and prefer to have their investments that have stable income. So outside the stock market, for instance, you notice that people who are the older age will prefer to place their investments in government securities, for instance, bonds, treasury bills, simply because those are deemed to risk-free. Okay, but high energetic person, young, has a higher risk tolerance because they still have time anyway to learn, to swallow losses, or get back up and start again. But our folks on the other side, that live their life now, the risk appetite is on the lower end, and for them it's stable income. So yes, age does affect risk profile. Gender, my take on this one is, yeah, it's balanced. I wouldn't say men are more risk takers than women, but if I'm to be biased to the girl child, I think women are actually more risk takers than men. I hope that answers your question, Sandra. But please send your email address on the chat, and we'll share more details on dividend policies. Thank you.
Okay, thank you so much, Spiro, for that. And for now, Mr. Justin is going to be the last person on the Q&A. So Mr. Justin, you can go forward.
Good afternoon. Okay, so my question is, the LuSE being a growing market, is a bear market, is the bear market a risk that all investors on the Lusaka Stock Exchange should be prepared for? Or is it relatively a small and growing market that maybe a bear market is something that is unlikely to occur? Thank you.
Hi, Webster. Thank you for that. So looking at past performance of the LuSE, and we can actually base some projections on how it will perform. A bear market is not something that we actually expect in the medium to long term. And for the sake of everybody on the call, those that don't understand a bear market, this is a period when prices of stocks fall by 20% or more from recent highs, and then they stay low for a sustained period. If you were on the call last week when we were looking at performance for these listed companies, you will notice that yes, there were a few companies that were fallen into the minus or maybe just falling actually, but from the performance that we assessed, and we can actually even do conservative projections based on historic performance, a bear market is not likely to occur on the Lusaka Securities Exchange. I hope that answers your question, Webster.
All right. All right. So since we still have some time on our hands, we are going to allow one more question. If you're interested in asking any question, you can raise your hand. Okay, so Juliana, you can go ahead with your question.
Good afternoon, everyone. I just wanted to understand what drives people who want to have growth investment versus income investment, because I'm meant to believe that everybody is investing for eventually growth. Even if they want to grow, they still want it back as their income. I just want to understand why others would really focus on growth investments. Thank you very much.
Well, thanks for your question, Juliana. So the focus on what type of stocks here, be it for growth or income, again, is dependent on what are your investment objectives. So those who would be primarily focused on growth counters would be those who have longer investment horizons, because growth on the securities market happens in the medium to long term. But there are others who do not have that leisure of time and their investments. So those that have a longer investment horizon will actually focus more on growth, not that they'll shy away from income counters, but their focus is more on the growth side. Those that have the luxury of time to amass the capital gains on their investment. Thank you.
right. I can see we still have some hands raised. So I am going to advise the people who still have their hands raised to go to the comment section. Kindly ask your questions from there. We have our relationship manager. All your queries are going to be answered swiftly. And also, if you would like to contact us, we have a pinned comment. All our contact details are there. You can still send us a message even on WhatsApp or direct text or more professionally our email. So through our email, we're going to answer all your questions. So now to lead the way to the closing remarks, I would like to introduce one of our managing partners, Teresa Gumbo, who's going to give the closing remarks.
Thank you so much, Blessings. Good afternoon, everyone. So on behalf of Money Acumen Advisory, I would just like to extend our sincere appreciation to each one of you that took time off your busy schedules to attend this particular webinar this afternoon. And also a special thank you to Spiwe, who was presenting this afternoon. I think most of her insights have shed valuable light or insight on how investors can navigate today's market. And also, what I just wanted to stress out to everyone who's attended this afternoon's webinar is that Money Acumen actually prides itself with a team that's highly skilled, very efficient and experienced. So we are very committed to delivering sound, research-driven investment guidance. And also we actually pride ourselves in delivering most of these services very efficiently. So what you have actually witnessed this afternoon or this past 45 minutes today is just a glimpse of the sort of expertise we bring to the table. And also, we believe that every single investor, everyone who's attended this particular webinar, has got interest in investing, or you've probably actually been investing for a very long time. And we believe that you deserve a partner who not only understands the markets, but also understands your goals. And I think what we do very well here at Money Acumen is understanding each one's objectives. Going back to the question that Spiwa was answering just right before I could speak, she spoke about objectives. We usually focus more on what the client is trying to achieve, and then we tailor that particular investment to your desired goals. So our doors are open to each one of you, and we would be honored to support you in structuring your portfolios that safeguard your capital. We are very equipped when it comes to managing risk effectively, depending on your risk appetite as a client, and also just to position you for sustainable long-term growth. Remember, investments, especially when it comes to stocks, are a long-term game, and we are very much positioned to manage risk effectively. So thank you so much once again for joining us. We look forward to engaging with you further and just exploring how we can work together on your investment journey. So do get in touch with us, or you'll probably receive an email from us just right after this particular webinar, and then we can take it up from there. Thank you so much.
Yeah. Okay, that was an amazing close. Thank you so much, Teresa. And thank you to each and every one of you who attended our third series. And I would just like to give a note. This meeting is being recorded, and after this meeting, you're going to receive emails. Those emails will be linked to our next webinar. And at the same time, keep checking your emails, because once we upload on YouTube, you'll be able to still go through the meeting. Otherwise, this brings us to a close. Thank you so much. And for those people who still have questions, please, you can still ask questions in the chat, and our team members will attend to you. Otherwise, thank you so much for attending and have a blessed day.
Thank you so much. Goodbye.